All right, you and I were talking about sort of like, well, first of all, we want to get around and talk about rates. I mean, with the Fed, in all likelihood, looking to make what amounts to be like a 100 BPS cut, which is equivalent of 1 full percent on the borrowing rate, which would push the rate down closer to 3%. I think 3.3, 3.25, somewhere in that ballpark. The question is, sort of like, when does that happen? How quickly do we get to these cuts? Fed Governor Chris Waller had said, that he could foresee, these cuts occurring between now and the end of the year, which would mean that a 25 basis point cut might be out and a 50 point basis cut might be coming in the next next decision period, which is, what are we, about 2 weeks away from that? What are you thinking? How are you looking at this, and what do you think the number's going to be? And then let's talk about the housing market. Let's talk about rates for customers, and let's talk about, what's going to be available, on the market, because all these things are sort of moving on their own. Yeah.
Yeah. So, well, let's talk about the Fed briefly. I still think the Fed is kind of potentially already behind the curve a little bit. Think that if
President Trump has been dogging Jerome Powell, Fed chairman, about being too late, Powell, for it feels like months, right?
Yeah, I know, but the problem is the president is partly responsible for why the Fed is.
Well, yeah, right. I mean, he's rewiring the economy, and tariffs have been. I mean, look, you got people that really know what they're doing, like you, that look at tariffs and are like, oh, hey, I don't know. I mean, because the tariff rate's this today, it's that tomorrow, and it's back to this the next day.
Exactly. It's that uncertainty that's the problem, really.
Yeah.
It makes it very difficult to forecast where anything's going.
Right. And of course, this is all headed toward the Supreme Court in terms of legality, which could unwind a lot of things. We talked in the previous episode about rebates potentially coming. And, that would be.
It makes the math very difficult for the Fed.
It makes it impossible. And for everybody.
And for
everybody
else.
Right.
That's right. So
what do you think the Fed, with the data that's available now and the understanding? I mean, you can't just wait, right? I mean, there are signs in the economy that aren't good. Jobs numbers are down. The inflation indicators are up. This economy needs a little bit of a goose to get going here, right?
Yeah.
Oh,
so the Fed's going to cut in September. That's it. I think that's almost a given now. I think the Fed should probably cut at every meeting,
between now and the end of the year.
Oh yeah. At least until maybe, June. Remember there's no
until meeting. June.
Yeah. June 2026. I think the Fed's going to have to cut a few times. Because remember, there's no I think at January to March, you got a gap there, so, it front loads some of those cuts and then waits and see what happens, or at least it signals to markets that it's ready to cut at every meeting.
How many meetings are there going to be where a cut would be potential between now and the end of the year?
We got, 1, 2, 3, 4. I think four. I
think it's right.
So if we cut 25 basis points every meeting, we get down by 100 basis points.
By January 1st.
No, I would say, we get to, now I think maybe that might be too much by January 1st, but I don't know. I mean, my thought here is the Fed's definitely going to be worried about, is going to want to pay attention to what the labor market's doing. So it's going to want to cut, but then it's going to want to pause and look to see what happens.
Yep.
Right.
Okay.
While still signaling that more cuts are coming should the economy need it. What does it mean for the labor market and the housing market? Right. Ultimately, on the labor market front, if businesses believe, if the cost of financing, short-term financing goes down and businesses are able to refinance loans, right? They feel good. The big question is going to be, are they going to go ahead and hire new workers, expand their operations, do a bunch of stuff with, right? Or are they going to just kind of like batten down the hatches, right? And ultimately the answer to that question sits with the consumer. Is the consumer going to go out and spend or not? Right? Am I getting a raise in January, or should I be saving as much as possible because I don't know where this economy is going? Ultimately, the uncertainty is the killer here for consumers and businesses. And so getting rid of that uncertainty, right? With fewer crazy headlines of policy changes, right? Of a labor market crashing, right? That stuff has to go. We cannot have any of that. So the Fed's going to do its best to put money back in the hands of people, just so it prevents a deeper downturn. Now, of course, tariff rebates, we talked about that briefly. Tariff rebates are basically checks coming back, right? And so that's going to be stimulated. It's like, well, it depends. Is it going to be saved, invested, spent, right? So we'll see. But again, tariff rebates might actually be a positive that helps the Fed in a way.
Let me ask you this. I mean, as we bring it back to rates and what's the potential opportunity for rates? Because I mean, I wanted to try to at least slip some of the housing, thinking into this.
Mortgage rates, I can tell you right now, mortgage rates are not likely to go down very much.
We're at 6.5% per, Freddie Mac on a 30-year fixed national average, right? 5.6% on a 15-year rate right now. I mean,
yes.
So when you're looking at it, we're going into not necessarily the quiet time in the market, but we're off peak. So I mean, are there going to be some values out there?
Here's the good news. Compared to a year ago, remember a year ago, after the Fed cut 50 basis points, mortgage rates actually increased. They went up a lot. Q4 of last year was awful in terms of mortgage rates.
Right. We were back up over 7% at that point.
That's right. This time around, because of the downturn fears, right? The growth concerns reemerging. I don't think we're going to get the increase in mortgage rates that we got last year, which I think is a positive, because ultimately what that means is mortgage rates in Q4 could be lower than they were a year ago. Right. And I think that's nice. That's nice. It's going to be lower, but not that much lower. Right. And so I think consumers need to understand that, mortgage rates aren't going to come down.
Not wildly, and not one for one with the cuts at the.
They're not. And so you got to get used to the current mortgage rate environment. You got to take the wins while you have them. Here's what I mean by the wins. You have the highest level of inventory since 2019, November 2019, right? You have more bargaining power. You have the ability to get price cuts from sellers.
Yes, we're seeing pricing changes favoring the buyer substantially. Although I did see a stat from Zillow. This was through the 31st of July. So this is data it's not stale, but it's your most recent data. It's not the newest data, but it's the most recent data. That still 32% of home buyers paid the asking price or above.
Yeah. Well, I mean,
depending on the market where you are. So I mean, this is not.
It's the housing. They're like their homes, right? There are homes that command a premium. All right, and there was also. Part of it is also the strategy, right? Some sellers will actually put a lower price, attract a bunch of offers, and then buyers end up bidding it up, right? So I love that stat, but that stat, I like looking at our price cut stats more than.
Sure. So what are those looking like?
Right. Lots of price cuts across the board. The highest number since Zillow's been tracking, right? Then Zillow has this thing called the market heat index, which is just another really great metric that I track every day. That I love tracking, because what it shows is basically the balance of bargaining power between buyers and sellers. And it's the best it's been for buyers in a long time. But the problem is that may not last forever. I mean, potential buyers have to be aware of that basically they're almost at a sweet spot where rates have come down a little bit and where they have a ton of options and they can get discounts. Because you know what's happening right now? When I look at the data, sellers are pulling back. Sellers they're seeing a record or on near record, housing wealth. They have very low mortgage payments. They don't necessarily have to sell, right? They're pulling back and now inventory is not growing anymore. By the way, part of that is, of course, the slow season, right? In the summer, nobody lists their homes for sales, right? They wait out the spring. But at the same time, you probably have some sellers delisting and saying, hey, I'm just going to wait it out. And so that shrinks the pool of homes available for potential buyers, right? And so again, that shifts the dynamic again. And so if you want to take advantage of the current dynamic, that if you have less savings and you want to move and you need to buy a house right now, this might be the time instead of trying to time the market.
Yeah. Well, I appreciate your thoughts as always. It's complex. There's a lot of, it's not just one thing that's influencing this market. There's a gazillion things that are influencing the market. So good conversation. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics, wherever you get your podcasts. And make sure that you listen to Dr. O and me every week on the Center Square Radio Hour.